Right now, as we, endlessly debate which AI chatbot is the absolute smartest or which tech CEO is the ultimate visionary, there's a $1.2 trillion financial giant quietly pouring billions of dollars into concrete.
Right. Concrete, copper wire, and distressed corporate debt.
Exactly. They aren't trying to predict the future. They are, aggressively buying up the physical reality required to run it. So welcome to this deep dive. Today, we are looking at the ultimate blueprint for that physical future by tearing into the Q1 2026 earnings report from Brookfield Asset Management, or BAM.
Yeah, bam.
They released this on May 8th, 2026. And to say their strategy offers a masterclass in market positioning would be, well, it'd be a massive understatement.
Oh, absolutely. And we have a really pristine stack of materials to guide us through this today. I mean, we are pulling directly from BAM's official Q1 earnings press release.
Yeah.
And their, highly detailed Q1 supplemental information slides.
Which are dense, but so good. So dense. But we also have the full earnings call transcript, which features some incredibly candid structural analysis from their CEO, Connor Teskey, and their co-CEO of Credit, Armin Panossian.
Yeah, and the overarching theme across all these documents is like an almost ruthless capitalization on one single concept, which is physical and financial scarcity.
Exactly. Scarcity is the whole game here.
Right. So our mission today for you, the listener, is to decode the mechanics of these strategic moves by tracking exactly where BAM is deploying capital and, just as importantly, where they are refusing to deploy it. You're going to see how the smartest money in the room navigates high geopolitical uncertainty.
And the massive energy-draining AI boom.
Yes, plus a fundamental recalibration of global credit markets.
Yeah.
Okay, let's unpack this. Starting with the sheer scale of the financial leverage they brought into the first quarter of 2026.
Yeah, looking at their balance sheet, the scale is genuinely difficult to conceptualize. They are projecting 2026 to be the largest fundraising year in the company's entire history.
Which is saying something. Right. Their fee-related earnings, so, that stable recurring revenue generated simply for managing the capital that hit $772 million in Q1 alone.
Wow.
Yeah, it's an 11% year-over-year increase. They pulled in $21 billion in new capital this quarter, bringing their year-to-date total to $67 billion.
And a significant chunk of that year-to-date number comes from a massive $40 billion mandate, right? The one tied to their acquisition of the UK retirement services firm, Just Group.
That's the one.
So that bumps their total fee-bearing capital up to $614 billion. But for me, the figure that actually dictates their market power right now isn't that. It's their $137 billion in uncalled fund commitments.
Yes. The dry powder.
Exactly. And notably, $67 billion of that isn't even earning fees yet. We frequently call this, dry powder. But we really need to look at the mechanical advantage of holding that capital in reserve, especially during a high interest rate environment.
It's a huge advantage.
Right, because holding $137 billion in uncalled commitments is it's like sitting on a massive, tightly coiled spring or, a fully fueled rocket just strapped to the launch pad. The beauty of this structure is the option value.
Yeah, because they don't have the drag of holding costs.
Exactly. BAM has the contractual right to call down those billions the absolute second a distressed asset hits the market. But they aren't carrying the massive holding costs or, the return expectations of deployed capital while they wait for the perfect target.
But, that structural advantage is entirely dependent on institutional trust. I mean, the obvious question you have to ask is why sovereign wealth funds and massive state pension plans are willing to lock up unprecedented amounts of capital with BAM in the first place.
Right. Why them?
Well, the answer lies in a major behavioral shift among mega allocators. Like 10 or 15 years ago, a $100 billion pension fund might have fragmented its capital across 50 or 60 boutique managers just to achieve diversification.
Oh, man. Managing that many relationships in today's fractured geopolitical and economic landscape sounds like an administrative nightmare.
Oh, it is. It's wildly inefficient. So these global institutions are now actively consolidating their capital. They want to partner with a handful of apex managers who can, architect multi-asset globally integrated solutions.
Make it a one-stop shop.
Exactly.
Yeah.
An institution can go to BAM and mandate a bespoke portfolio requiring European renewable infrastructure, Asian logistics real estate, and North American private credit all at once.
And BAM can actually do it.
Right. BAM is one of perhaps 3 or 4 firms on the planet possessing the internal infrastructure to say, yes, We can deploy that $10 billion mandate in-house across all those verticals. That consolidation trend is fundamentally accelerating their capital accumulation.
Which brings us to the actual application of that capital. So with $137 billion in uncalled commitments, they are aiming squarely at the bottlenecks of the modern economy. And the most glaring bottleneck right now isn't in the cloud, it's on the ground.
Yeah, physical infrastructure.
Right. BAM is bypassing the volatile software side of the AI boom entirely. Instead, they're pouring capital into the physical infrastructure that makes artificial intelligence mathematically possible.
Yeah, and if we connect this to the bigger picture, BAM's executives made it explicitly clear on the earnings call. I mean, they view artificial intelligence not as a disruption risk to their core business, but as the most significant macro tailwind of the decade.
Which is a bold claim.
It is, but think about it. The market is obsessed with debating which tech giant has the superior large language model. But BAM is entirely agnostic about who wins the algorithm war, because every single one of those generative AI models requires an incomprehensible amount of electricity.
The water, right.
Yeah, specialized liquid cooling architecture, massive hyperscale data centers, and the high-capacity fiber optic networks linking them globally.
It really is the classic California gold rush scenario all over again. But we need to look at the actual mechanism of how they are, selling the pickaxes, because BAM isn't just building generic data centers on speculation.
No, not at all.
They are locking the hyperscalers, so the Amazons, Microsofts, and Googles of the world, into 15 or 20-year power purchase agreements, or PPAs. By securing these long-term contracts before the foundation is even poured, BAM effectively shifts the underlying capital risk away from themselves and onto the tech giants.
That's the genius of it.
Right. They are securing guaranteed inflation-linked yield for decades. And you can really see this conviction in their $5 billion partnership with Bloom Energy inside their AI infrastructure fund.
Oh, the Bloom Energy deal is massive.
Yeah. During the call, Connor Teskey didn't just highlight the partnership. He actually noted they're in advanced discussions to expand it by multiples, not like by a small percentage increase,
By
multiples.
Yeah, and that phrasing is a massive signal to the market. In a macroeconomic environment that is, still grappling with inflation and supply chain fragility, physical assets command a huge premium.
Because the grid just can't keep up.
Exactly. The macro grid simply cannot handle the power density required by next-generation AI processors. So by integrating a company like Bloom Energy, which specializes in solid oxide fuel cells that can generate power on-site without relying on the strained grid, BAM is effectively selling energy independence to tech companies that are desperate to train their next models.
Wow.
Yeah, they're monetizing the physical scarcity of electricity.
And that scarcity theme transitions us perfectly into their strategy in the credit markets, right? Where we are seeing the scarcity of cheap capital utterly break the previous financial paradigm.
I will completely break it.
This is where the integration of Oaktree Capital Management comes into focus. BAM is closing the 100% integration of Oaktree in the second quarter, and Oaktree is legendary in the distressed debt space, so bringing them fully in-house gives BAM an unparalleled capability to exploit the fractures forming in direct lending.
Yeah, because the credit market is undergoing a brutal recalibration right now. During the zero interest rate anomaly of the past few years, we saw a total collapse in underwriting discipline within the direct lending space.
It was the Wild West.
It really was. The executives on the call specifically targeted the proliferation of high leverage and loose covenants, calling out mechanisms like PIIK, or payment in kind structures.
Yeah, and for those of you tracking the debt markets, payment in kind is basically a mechanism where a distressed company avoids paying cash interest by simply adding that interest to their principal debt balance.
Which is terrifying.
It is. It's the corporate equivalent of paying your mortgage with a high-yield credit card. I mean, it masks insolvency as long as capital remains free. But the moment the cost of capital normalizes, those companies just suffocate under the compounded debt load.
Exactly.
And BAM made a point to broadcast that they have virtually zero exposure to sponsor-oriented direct lending and software buyouts. They sat completely on the sidelines while their competitors chased those deals. Now, I have to push back here a little bit.
Okay, let's hear it.
Wait, by completely avoiding direct lending and software during one of the most aggressive bull runs in private equity history, isn't BAM guilty of playing it overly safe? Like, I hear discipline on the earnings call, but from an investor standpoint, it sounds a lot like cowardice. Did they just forfeit massive returns out of an abundance of caution?
No, it is pure calculated predation. I mean, Oaktree's reputation is built exactly on this type of cycle. They willingly sacrificed short-term, high-risk yield because the underlying math of those over-leveraged software buyouts was fundamentally flawed.
They saw the writing on the wall.
Exactly. They watched competing managers raise billions and deploy it into companies with zero margin for error. Oaktree prioritized long-term survival and capital preservation over quarterly fee generation. And now, the bill for that era of free money is coming due in the form of a historic maturity wall.
Ah, the LBO maturity wall. The loans taken out to fund those massive leveraged buyouts in 2020 and 2021 were typically structured with, what, 5 to 7 year terms?
Exactly. And BAM is currently tracking deep, sector-specific distress across software, building products, chemicals, and autos. The debt holding those companies together is set to expire primarily in 2027 and 2028.
Oh, wow. Right around the corner.
Yeah. Those businesses will be forced to refinance their entire capital structure at today's interest rates, which are drastically higher than when the original loans were written. The cash flows of those underlying businesses simply cannot cover the new debt service.
Which means technical defaults, restructuring, and bankruptcies.
Bingo.
And Armin Panassian, the co-CEO of Credit, stated point blank that if this dislocation materializes as they expect, Oaktree's capacity to deploy capital into these distressed assets is measured in the tens of billions over a 12 to 24-month window.
Tens of billions.
Just waiting. Right. They purposefully kept their powder dry so they could hover above the wreckage, acting as the sole liquidity provider for desperate sellers. They are going to step in and acquire premium corporate assets at steep discounts because they are literally the only ones left with the capital to orchestrate the restructuring.
It's the ultimate execution of patience as a strategic weapon. They didn't just avoid the trap. I mean, they waited for everyone else to walk into it so they could buy the trap itself.
That is perfectly put.
And we see this exact same contrarian exploitation of supply dynamics playing out in a sector that the broader public currently considers completely toxic.
Commercial real estate.
Commercial real estate.
Yeah, the public narrative around commercial real estate is entirely apocalyptic right now. Like, the prevailing story is that remote work permanently hollowed out the office sector, and high interest rates have paralyzed transactions.
Right, that's what everyone thinks.
But Connor Teskey explicitly pushed back against that narrative. He stated that the real estate recovery is rapidly accelerating far ahead of the headlines. And they aren't just theorizing about this. They are targeting $20 billion in real estate transactions in a concentrated 2-month period.
20 billion.
In 2 months. Yeah. Now, a large portion of that targets logistics and housing, which, aligns with standard growth models. But the revelation that premium office and retail spaces are next on their acquisition list points to an incredible underlying market mechanic.
Yeah, what's fascinating here is how the microeconomics of physical construction are completely overriding the macro narrative of reduced office demand. The media focuses entirely on the demand side, occupancy rates and return to office mandates. But BAM is hyper-focused on the supply side.
Right, because the supply side literally froze. Like, if you think about the physical reality of building a skyscraper or a premium retail center, when the pandemic hit in 2020, new ground breaks stopped globally.
Everything just halted.
And just as the physical lockdowns ended, the cost of construction financing skyrocketed due to rate hikes, while the cost of materials exploded due to inflation. As a result, the global pipeline for new commercial construction has been essentially zero for half a decade.
Which is wild when you think about it.
So even if the aggregate demand for office space has softened slightly due to hybrid work models, the supply of high-quality, modern, environmentally compliant office space has completely flatlined.
And that is the exact asymmetry BAM is targeting. As major corporations mandate a return to the office, they aren't looking for massive, outdated cubicle farms. They're competing for highly amenitized premium spaces in Tier 1 global cities to attract talent.
Right, the flight to quality.
Exactly.
Yeah.
But because of that multi-year construction pause, there are no new buildings coming online to absorb that demand.
So a global pandemic's construction pause accidentally engineered an absolute goldmine for whoever holds the keys to the existing premium inventory. The supply shock transferred all the pricing power directly to the existing landlords.
It really did.
The earnings call noted that due to this acute scarcity, rents for these top-tier assets in key markets are soaring. Some have jumped 50 to 80% compared to 5 years ago.
That is a staggering increase.
Yeah. BAM isn't making a blind bet on the office sector recovering. They are exploiting a mathematically guaranteed supply shortage that will take a decade to physically build our way out of.
It is another prime example of recognizing where scarcity creates a pricing moat. whether it is a scarcity of power on the grid, a scarcity of capital in the credit markets, or a scarcity of steel and glass in Manhattan. BAM's entire portfolio is engineered to capture the premium generated by a lack of supply.
Okay, so what does this all mean for the structure of BAM itself? And more importantly, how does this institutional strategy intersect with the everyday investor listening to us right now? Let's look at how they are managing their own corporate balance sheet first, because the mechanics of their capital allocation reveal a lot about their internal conviction.
Yeah, let's get into the CFO's numbers.
The CFO, Hadley Peer Marshall, noted they've opportunistically repurchased nearly $800 million of their own stock over the last 7 months.
Right, and that buyback strategy is occurring alongside some very deliberate debt issuance. They ended the quarter with $2.5 billion in corporate liquidity.
Plenty of cash.
Exactly. Yet, immediately after the quarter closed, they successfully issued $1 billion in 10-year senior notes, yielding approximately 5.3%.
Which raises an interesting mechanical question, right? Why would a company sitting on $2.5 billion in cash choose to take on $1 billion of new debt at 5.3% while simultaneously spending $800 million to buy back its own shares?
It comes down to capital arbitrage.
Yes. BAM's management clearly believes the intrinsic value of their equity, driven by those massive fee-bearing capital streams we discussed earlier, will compound at a rate significantly higher than 5.3% over the next decade.
Which is a very safe bet for them.
Yeah, they are locking in fixed-rate debt to fund the repurchase of what they view as severely undervalued equity. It is an aggressive optimization of their capital stack.
It signals supreme confidence in their forward cash flows, honestly. But the shift that directly impacts the individual investor is BAM's aggressive push to democratize these alternative assets.
This is the part that blew my mind.
Yeah, historically, the types of investments we've been discussing, like 20-year power purchase agreements, distressed corporate debt restructurings,
Yeah.
and multi-billion-dollar infrastructure portfolios, they were entirely gated.
Totally off limits to retail.
Exactly. Only sovereign wealth funds and ultra-high net worth individuals had the capital scale required to access that kind of inflation-protected, downside-mitigated yield.
But that structural barrier is breaking down. BAM is expanding their retail and private wealth products at a 40% growth rate. But the most disruptive element they discussed was their advancement into the everyday retirement market.
Yeah, the 401k integration.
Right. They are currently in advanced negotiations to integrate their real asset products directly into 401k target date default portfolios.
And the mechanical implications of that are staggering, if you think about it. I mean, a target date fund is the default investment vehicle for tens of millions of corporate employees.
You set it and forget it.
Right. By embedding alternative assets into those structures, BAM is functionally rewiring the mechanics of everyday retirement. Without having to actively manage their accounts, retail investors will suddenly have fractional exposure to the exact same data centers, renewable energy grids, and premium real estate assets that the world's largest sovereign wealth funds are acquiring.
It bridges the gap between institutional macro strategy and individual retirement planning. It moves the everyday investor away from pure reliance on volatile public equities and anchors their wealth in the physical, scarce assets of the real economy.
Which is a massive paradigm shift.
It really is.
Yeah.
Okay, let's pull the threads of this deep dive together. We started by examining a $1.2 trillion financial apex predator sitting on $137 billion of uncalled dry powder.
Waiting for the perfect strike.
Exactly. We unpacked the mechanics of their AI strategy, showing how they are bypassing the speculative software wars to lock hyperscalers into decades-long power contracts through assets like Bloom Energy.
Monetizing the power bottleneck.
Right. We explored the deliberate, calculated patience of the Oaktree integration, positioning tens of billions of dollars to exploit the upcoming LBO maturity wall as overleveraged companies hit a brutal refinancing cliff. And we broke down the hidden microeconomics of the commercial real estate market, where a multi-year halt in global construction has engineered a massive supply shock, driving top-tier rents up 80%.
Throughout all of this, the connecting tissue is the monetization of scarcity. BAM uses its sheer scale to position itself as the sole provider of whatever the market lacks, whether that is bespoke multi-asset management for institutions, physical power for AI, liquidity for distressed corporations, or premium real estate in Tier 1 cities.
It is a blueprint for how the absolute highest tier of global capital operates. But before we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought to mull over based on the structural shifts we've mapped out today.
Yeah, and this is something to really chew on. For the last 40 years, the bedrock of everyday financial planning has been the traditional 60-40 portfolio, allocating 60% to public stocks for growth and 40% to government or corporate bonds for
Okay.
downside protection.
It was the unquestioned consensus for building secure wealth.
Right. But if an entity with the scale and insight of a $1.2 trillion manager is definitively proving that true safety, inflation protection, and compounding growth now rely almost entirely on physical alternative infrastructure, distressed private credit, and supply-constrained real estate, is it time for the individual investor to completely abandon the 60-40 model and rethink what a structurally sound core portfolio actually looks like in the 21st century?
If the smartest institutional money on earth is utilizing its capital to pour cement and acquire distressed debt instead of chasing public tech valuations, perhaps our baseline assumptions about financial security need a radical update. Thank you for joining us on this deep dive into the mechanics of global capital. Keep questioning the consensus, keep looking for the underlying mechanisms driving the market, and we will catch you next time.